Welcome to today's Explainer. Today, we're popping the hood on the Nippon India Large Cap Fund. If you've been searching for a solid way to structure your long-term wealth, you've definitely come across this absolute giant in the Indian mutual fund space. So we're going to dig right into the data to understand its hidden mechanics, its real risks, and its true wealth-building potential.
Here's our roadmap for today. Large caps for beginners, historical performance and returns, analyzing market volatility, resilience, decoding advanced risk metrics, contrasting peers and benchmarks, and finally, planning long-term wealth. Let's jump in.
Section 1. Large Caps for Beginners. Building a Conservative Anchor. Okay, so what does this actually mean? Well, these funds buy into the top 100 companies by market capitalization. You're basically trading away that crazy, explosive short-term growth you might see in small caps because, these massive giants have already hit the peak of their initial growth curves. But in return, you get incredible stability. You are investing in India's most established, mature businesses. It's really like building your portfolio on bedrock. Check out how they actually split up the money. You've got this massive 81% large cap core, providing that promised stability. But notice this really clever, carefully calculated growth kicker, a 12.3% mid cap and 2.5% small cap slice. If you're a conservative investor trying to understand market cap distribution, this is the exact insight you need. It perfectly balances risk protection with just enough aggressive upward momentum. Section 2. Historical Performance and Returns. 18 years of market cycles. Now, to really grasp how they pull off their historical returns, we have to talk about GARP, growth at a reasonable price. This is literally the fund manager's core philosophy. It means they absolutely refuse to blindly overpay for future earnings. No chasing hype here. They want sustainable business models and rising returns on equity, but they are ruthlessly valuation conscious. If a sector is just too expensive, they'll simply sit on their hands and wait for the price to drop back to reality. So does this GARP strategy actually work? Well, for beginners trying to assess long-term capital growth, the proof is right here in the numbers. We're looking at a 5.14% return over the past year. But honestly, for a long-term vehicle, look at the 3- and 5-year marks. It compounded at a whopping 16.20% over 3 years and an even better 17.30% over 5 years. Across all of these time horizons, it consistently leaves its benchmark, the Nifty 100 average, in the dust. Section 3. Analyzing market volatility resilience, weathering the storm. Absolute returns are great, but they really only tell half the story. Capture ratios show us a fund's true resilience during recent market volatility. Look at this. When the market goes up, the fund captures 107% of those gains. It actually outpaces a rising market. But the real magic is that red bar. When the market falls, it only captures 85% of the index's losses. You're grabbing more of the upside and suffering significantly less of the downside. That is a huge win. And you can see this downside protection crystal clear in the maximum drawdown metric. This just looks at the worst-case scenario, the biggest drop from peak to trough during the absolute worst market periods. While the broader benchmark index took a brutal hit of almost 19%, the Nippon India Fund stopped the bleeding at minus 14.32%. Meaning, when the financial storms hit, this fund threw up a shield and protected your capital way better than the broader market did. Section 4. Decoding Advanced Risk Metrics. The math behind the moves. Let's nerd out for a second and look at the actual math institutional investors use. First up is standard deviation, which measures the sheer volatility of the returns. Think of this as the size of the waves in the ocean. A lower number means a much smoother ride for you. The fund's standard deviation is sitting pretty at 14.21%, noticeably below the index's 15.55%. That proves mathematically that all those great returns we just talked about are generated with far less wild swinging. Next up is beta. If standard deviation is the size of the waves, beta is how much your specific boat rocks when those waves hit. A beta of 1.0 means you rock exactly as much as the market. But here we have a beta of 0.96, so it's mathematically proven to be slightly less sensitive to violent market swings than the broader Nifty 100 index. It's inherently a slightly less risky asset. And finally, we get to alpha. Oh man, this is the holy grail for active fund managers. Alpha measures the manager's specific value add beyond just riding the market wave. Think of it as how fast the captain is rowing ahead of the current. A massive alpha of over 4.0 demonstrates that the management team's specific stock picks and sector calls are generating serious excess returns, entirely independent of broader market momentum. They aren't just floating, they're actively rowing.
Section 5. Contrasting peers and benchmarks. Stacking up against the giants. So how does it hold its own against the heavyweights? When you stack Nippon India directly against giants like ICICI Pru Blue Chip and HDFC Large Cap, it boasts a superior 3-year and 5-year return profile. Plus, it handily beats our primary large and mid-cap universe benchmark, the Nifty 100. But here is the absolute best part. It pulls off this outperformance while charging you the lowest direct expense ratio in this group, just 0.71%. You are literally paying less in fees to get better historical performance. But hey, we all know it's not just about what you make, it's about what you keep. The 2024 tax rules changed the landscape. If you cash out in under 12 months, you're getting slapped with a heavy 20% short-term tax. Ouch. But if you hold for over a year, long-term capital gains over 1.25 lakh are taxed at just 12.5%. These rules make holding this fund for the long haul absolutely crucial for your tax efficiency. Section 6. Planning long-term wealth. The multiplier effect. Let's bring this all home. Historical multiplier data is pretty much the ultimate tool for assisting with long-term wealth planning. Imagine this. A simple, disciplined 10,000 rupees monthly SIP into this fund since its inception has snowballed into 1.04 crore rupees over 15 years. And get this, that was from just 22 lakhs of actual invested capital. If you ever needed proof of the incredible compounding power of a well-managed, low-volatility large-cap fund, there it is. From the conservative nature of large caps to that high alpha and the serious downside protection, the data spells out exactly why this fund commands over 50,000 crores in investor trust. We've peeled back all the layers today. The only question left is, knowing all these hidden mechanics, how are you going to use this data to construct your own long-term wealth strategy? Thanks for hanging out with me on today's Explainer, and keep learning.